Welcome to StockTok's deep dive into América Movil S.A.B to CV. This is one of the largest telecommunications carriers in Latin America, operating wireless and fixed-line services across the region. As of May 5th, the stock is trading at $27.25. The stock has moved up 4% over the trailing period, sitting near its 52-week high of $27.70. The 52-week low was $16.60, so we're in the upper end of that range. The Relative Strength Index, a momentum indicator, is at 63.4 neutral territory, neither overbought nor oversold. The 50-day moving average is at $25.30, while the 200-day is at $22.09. The price is above both key moving averages, which on a technical basis suggests near-term support. Let's work through the fundamentals, scene by scene, starting with a quick business overview. América Movil operates as a dominant pan-regional telecom incumbent, with strong fixed-line and wireless network assets across Mexico and Central America. The competitive moat rests on legacy infrastructure, existing customer bases, and established billing relationships, typical of mature, regulated telecom operators. The StockTok score is 34 out of 100, a sell signal. Breaking that down, valuation scores 7 out of 20, indicating the stock is not cheap. Financial health scores 9 out of 20, suggesting material balance sheet stress. Profitability scores 11 out of 20, which is respectable but not exceptional. Growth scores 5 out of 20, that's the real constraint. And smart money positioning scores just 2 out of 20, meaning institutional buyers are notably absent. Now, valuation. The question every investor has to answer: are you paying the right price? The price-to-earnings multiple on a trailing 12-month basis is 17.22 times. The forward price-to-earnings, which looks ahead to consensus earnings estimates, is 14.34 times lower, which usually signals expected earnings growth. But here's the problem. The PEG ratio, which divides the PE by expected growth, is 2.79. That is notably elevated. A PEG above 2 typically signals that near-term growth does not justify the current valuation multiple. The enterprise value to EBITDA multiple sits at 5.6 times, which is reasonable in absolute terms for a telecom. The price-to-sales ratio is 1.57 times. Now, let's consider the latest earnings results from the second quarter of 2025. Earnings per share came in at 40 cents, a miss against the 48-cent consensus estimate. Revenue came in at $236.84 billion, but that was against a $1 billion estimate, which appears to be a data error in the consensus collection. However, the year-over-year revenue comparison is the key metric, negative 3.3%. The company is shrinking on a top-line basis. Operating income stood at $52.24 billion and net income at $23.4 billion. After hours, the stock actually surged 1.3% despite that earnings miss, a head-scratcher that suggests some short covering or relief that results were not worse. Our DCF analysis suggests the stock is trading at a 0% margin of safety, in other words, at intrinsic value with no cushion. Wall Street's consensus mean price target is $27, right where the stock is now. However, the analyst price targets range from a low of $22 to a high of $34. That 14 analyst spread shows real disagreement in the professional community. Telecom comps like AT&T and Verizon in the United States typically trade in the 12 to 14 times forward earnings range. So América Movil is not obviously cheap on a relative basis. Market sentiment around América Movil leans neutral. There is insufficient recent news momentum to shift conviction either direction. In our view, the valuation offers no margin of safety, and the earnings miss combined with declining revenues suggests caution is warranted. Moving to financial strength, how solid is the foundation? The Piotroski F-score is 8.0 out of 9. This is a 9-point forensic checklist that grades the quality of earnings, cash generation, and balance sheet trends. An 8 is very strong. It suggests the company's reported profits are backed by genuine cash flow, and that core balance sheet metrics improved year over year. That's the good news. The bad news is the Altman Z score, which is 1.41. The Altman Z score is a bankruptcy risk model. A score below 1.8 suggests material distress risk. The company is in the warning zone. The core problem is leverage. The cash-to-debt ratio is 0.12, meaning the company has just 12 cents of cash for every dollar of debt. The debt-to-equity ratio is 1.71, which is very high. The company is financed more by debt than by equity. Interest coverage, which measures how many times operating income can cover interest expense, is 2.7 times. A healthy telecom typically wants 4 times or higher. At 2.7, there is limited cushion if revenues decline further or rates rise. The current ratio is 0.72, below 1. This means current liabilities exceed current assets, a sign of working capital tightness. In the context of a company that is already shrinking on the revenue top line, this balance sheet pressure is a material constraint. The foundation is not solid. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 7.11%. This measures how much profit the company generates per dollar of capital invested, equity plus debt. 7% is modest for a mature telecom and below the cost of capital for most investors, which means that in theory, the company is destroying shareholder value by earning below its required return. The gross margin is 62.19%, solid. Operating margin is 21.02%, respectable, and in line with large-cap telecom peers. Net margin is 9.23%, which means 9 cents of every revenue dollar reaches the bottom line. Free cash flow margin is 15.13%, meaning the company converts 15% of revenues into cash available to shareholders. That is the redeeming factor. Despite balance sheet stress, the company does generate meaningful free cash flow. However, return on equity, which shows the profit generated per dollar of shareholder capital, is 21.06%. That's healthy on an absolute basis, though it is inflated by the high leverage we saw earlier. Return on assets is 4.80%. The profitability metrics are acceptable on a standalone basis. But in the context of revenue decline in the latest quarter, margin compression is a real risk if the company is forced to cut prices to defend market share. Onto growth. Is this business expanding, and at what rate? The trailing 3-year revenue growth rate is 3.80%, a single-digit growth. The 5-year revenue growth rate is 4.40%. So the company is growing at low single digits, and the latest quarterly results showed negative 3.3% year-over-year revenue change. This is deceleration and a red flag. Book value growth over the trailing 3 years is 0.60%, essentially flat. The company is barely growing the equity base, which in a leveraged business is a concern. The dividend yield is 1.95%, modest relative to peers, and well below the current cost of capital for equity holders. The forward earnings estimate for the upcoming quarter in late July of 2026 is 45 cents per share, slightly higher than the 40-cent actuals we just saw, but the range is narrow, from 44 to 46 cents. That suggests limited growth acceleration expected by the analyst consensus. In our view, the growth profile is the core weakness. A company trading at 17 times earnings that grows at 4% is not compelling value. The earnings miss and revenue decline in the latest quarter suggests the risk is to the downside on growth expectations. Now let's talk smart money. What institutional capital is actually doing with this name? The data here is striking. 4 top-tier institutional investors, often referred to as gurus or the smart money crowd based on long-term track records, currently hold this stock. However, only 1.8% of 13F filers, the major institutional asset managers required to disclose their holdings quarterly, are net buyers at current prices. For context, anything below 50% indicates net selling or indifference. 1.8% is essentially no institutional buying. Insider ownership is 0%. The management team owns virtually none of their own company. That is a red flag. When executives have no skin in the game, they have less incentive to optimize shareholder value. Over the trailing 3 months, there have been 0 insider buys and 0 insider sells. No transactions at all. This silence suggests that insiders are not confident enough in the current price to buy, and not forced to sell, which is a neutral signal at best, and a negative signal when combined with 0% ownership. The absence of institutional buyers and the lack of insider confidence is a material concern. The smart money is either already positioned and not adding, or, more likely, they are not interested in deploying new capital here. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at 17 times trailing earnings with a DCF margin of 0% and a growth rate measured by the PEG ratio that does not support the current multiple. In our view, valuation offers no margin of safety. On financial strength, the balance sheet is stressed. The Altman Z score of 1.41 is in the distress zone, leverage is high, and interest coverage is tight. A company shrinking on the top line cannot afford this debt load indefinitely. On profitability, the metrics are respectable, but the latest quarter showed no earnings surprise upside, and margins could compress if pricing becomes more competitive. On growth, this is the core problem. Single-digit revenue growth, flat book value growth, and a latest quarter of negative 3.3% revenue. The business is not expanding, and earnings are not growing enough to justify the valuation. On smart money, institutional buyers are absent, insider ownership is 0, and insider activity is silent. The message from big money is clear: stay away. The latest earnings miss on both the bottom line and the top line reinforces our concern. The company missed on earnings per share, delivered negative revenue growth, and the marginal analyst enthusiasm suggests limited upside from current levels. Overall, based on what the data tells us, América Movil presents a setup that warrants caution. The valuation offers no margin of safety, the balance sheet is stressed, growth is decelerating, and smart money is not buying. This appears to be a value trap, a stock that looks cheap on valuation but cheap for a reason. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on América Movil. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.